name a few. Why are they going to offer superior opportunities for investors over some of the more traditional emerging markets?
Well, the frontier markets tend to be smaller, their capital markets are less developed, they generally have a lot more growth potential, they're much less integrated into the global economy. And as a result, you get a couple of advantages. Number one, a lot less growth has been tapped as they're migrating from more agricultural societies to more industrial, service-driven economies. That throws off a lot of growth potential. The BRIC economies have already seen a lot of that stage of their development, so the frontier markets offer more growth. But more importantly, it's much more domestically driven growth versus the BRICS that tend to be a lot more export driven, and therefore they're dependent on what's going on in the US or in Europe or in Japan. With the frontier economies, you're getting a lot more exposure to that really coveted domestic demand, consumer, middle class growth, infrastructure growth. It's more of a domestic story. And because they're less integrated and they're really moving more on their own fundamentals, the correlations to other asset classes in the frontier space tend to be a lot lower. So they can zig when other things zag and therefore provide more diversification benefits to your overall stock market portfolio.
Alec, you also wrote in a report, very interesting, that some of the companies in these countries are now really for the first time getting access to private capital. So how will that help change the equation?
Yeah, that's a really important catalyst right now because, frankly, the growth potential in places like Africa and smaller markets in Latin America and Asia and the Middle East have existed for a long time. What's changing now is that access to capital that we think is really key to unlocking, strong private sector-led growth. And the reason for that is that fear that really kept investors out for many years is starting to dissipate. Things like globalization and outsourcing are pushing more and more business into the frontier economies, and that's forcing those economies to become more transparent, establish more clear rules of the road. It's making foreign investors more comfortable with investing there, so we're seeing big increases in foreign direct investment into Africa and Latin America and other places. So it's not an overnight process, but relative to where we were in the 80s, 90s, and 2000s, we're definitely seeing more capital moving into these markets and transparency and rule of law dynamics really starting to improve, and that comfort level really needs to be there if the growth story is to take hold long term, and we think we may be at an inflection point there.
All right, let me tackle that transparency issue because that is always an issue with frontier markets. They're also not very liquid compared to what investors are used to. When you're looking and talking about earnings growth, you're not talking about GAAP earnings, are you, though? Isn't it hard to really make comparisons with some of the numbers? Can it be treacherous for investors?
Well, that's a fair point. I mean, we have to deal with the numbers that we have, and obviously accounting standards are going to vary, especially in some of these markets, but we have to try to normalize things and get some idea. And I think those metrics allow us to see that obviously valuations are significantly lower there, and there's pretty good growth potential. But I think even getting involved in that is kind of overthinking it a little bit. We would definitely recommend active management in the space. We're pretty big fans of passive management. Generally speaking, in frontier markets, we would definitely pay professionals to do the stock picking for you. They're going to have a much closer sense of those earnings fundamentals than you probably are. They're also going to be able to go anywhere globally. Templeton has some excellent products in this area. Wasatch also has some products that we like. So in the frontier space, we would definitely be recommending actively managed mutual funds, a bit more of an arm's length approach to investing in the asset class. And I'll just give you one anecdote to kind of throw out the kind of ground floor opportunity that we see here. In 1985, Mexico's stock market totaled about 1% of its GDP. Today, that's 40% of GDP. In 1985, Americans owned very little Mexican stocks. Today, we own about 20% of the Mexican stock market. So not that it's a perfect analogy, but we think over the next 30 years, you're going to see some of those dynamics play out in places like Nigeria, Kuwait, Peru, Vietnam, and we really would take a diversified, active manager, buy and hold type of approach to this area and not limit yourself to just the BRICS. They can be part of your strategy, but I think you really have to look more broadly than that in 2013 when you look at international investing.
Okay, very quickly, year-to-date returns 2013 for frontier markets. What would your expectations be? They're off to a strong start along with everything else.
Yeah, they're already up about 8%, whereas emerging markets that are focused more on BRIC are down about 4%. I think we can easily see a 15% type returns in the Frontier space this year. But again, I would urge your investors to really take a very long-term view here.